Good day. In this video, our group will present our reports on the financial analysis of Post Malaysia and GDEX. I am Michelle Wong Siu Han. My matrix number is 78146. We're presenting the background of the companies and their business and financial ratio analysis, the efficiency ratio. Post Malaysia or Post Malaysia Berhad is a national postal service provider in Malaysia. It is established as government agency in 1957 and corporatized as Post Malaysia in 1992. Due to the privatization program, Post Malaysia became a government-linked company in 2007. For more than 200 years, Post Malaysia had diversified to a dynamic company that have provided services such as postal, mail delivery, retail, logistics, aviation, financial service, and etc. As it transformed to an international company, Post Malaysia had invested in digitalizations to support the nationwide e-commerce business. It aims to deliver good service, which focus more on customer centricity while improving their operational efficiencies at all levels of the business in this blooming e-commerce industry. Besides that, Post Malaysia owns several businesses, such as Data Post Sdn Bhd and Aviation Sdn Bhd. Current strategy of Post Malaysia is three-phase strategy. First one of the strategy is back-to-back, which means zero black and fixed basis. The second phase is transform the core, which related to the cultural transformations, digitalizations, improvements in the growth and quality. The third phase is Post 2.0. That is about domestic leaderships, expansions of digital offerings, and end-to-end logistics operator. The second company is GDEX Sdn Bhd or GDEX. It is an express carrier corporation established in 1997. GDEX is the first local express delivery company that obtained quality management system of ISO 9001. Besides upgrading its QMS, it also obtained an environmental management system of ISO 14001 in 2012. In addition, GDEX has established GDEX Academy in 2018 for the National Dual Training System in collaboration with the Minister of Human Resources Malaysia. Service provided by GDEX include social commerce, GDEX Cool, which is for frozen and chilled, packaging solutions, and more. GDEX has few companies in different fields. For example, the GD Value Guard Sdn Bhd, which provide insurance agent service, and the VIVL Private Limited that provide advisory service in Singapore. The strategy practiced by GDEX is GDEX 2.0 for its transformation to a technology-driven company. This strategy focuses on the organizations of digital platforms, the formation of multiple business streams across Southeast Asia, and the innovations of digital solutions. In addition, GDEX practices 4P1S, which refers to the nurturing of people, effective process, improving the digital platform, the development of new solutions, and the increase of service quality and express delivery speed.
My name is Nuri Izzati binti Halim, and today I will be explaining about the industry outlook and information together with the leverage ratio of each company. Our group is analyzing Post Malaysia and also GDEX companies, so they are obviously under the CEP market industry, or also known as courier, express, and parcel industry. In the CEP industry, there are many great players who are working diligently, but the leading participants are DHL, Post Malaysia, Citylink Express, and also United Parcel Service or UPS. Besides, the CEP market is anticipated to expand at CAGR or compound annual growth rate over 9% in the study period of 2017 to 2022, with best year of 2021. This is because it's proven that during the global outbreak, delivery operations were not negatively impacted as there were in several other nations. According to Statista Research Department, courier service in Malaysia delivered about 737.36 million domestic courier items in 2021. That will influence on this industry in the future consists of drone deliveries, same-day courier services, and also business intelligence.
Hi, I'm Lau Kyung Jung. Now I am going to explain the SWOT for both GDEX and POS Malaysia. GDEX has the strength of wide geography reach, which means that it has a cyber partner and association group that support fast delivery of service to client and also management of industry-related competition issues. When it comes to the weakness, GDEX has higher operation costs in the trucking sectors as compared to its rivals. Second, GDEX has insufficient market penetration in new markets, which means that it must invest more in marketing, advertising, and promotional activities to increase its market penetration. When it comes to opportunities, the rapid technological development and innovation helps GDEX to raise production efficiency and expand considerably into related products. Second, the consumption patterns of consumers are evolving quickly due to the quick access of information and acceptance of technical products. So GDEX must pay close attention to both general changes in the transportation industry and in the trucking industry. When it comes to the trip, the express delivery is quite competitive with many participants. Rivals are following up with product development despite the fact that GDEX is still the industry leader in this era. Besides, the highest competitive in express delivery caused the shortage of experienced human capital, which GDEX may soon encounter issues relating to skilled human resources. And that is all about SWOT of GDEX. Now I will explain the SWOT of POS Malaysia. The strength of POS Malaysia consists of market leader position and strong brand recognition. In this service industry, POS Malaysia hold a commanding market leader position, and also the product from POS Malaysia are well known in the business sector. When it comes to weakness, business strategy is constant and similar with the rivals. The rivals in the service sector can readily copy the business strategy of POS Malaysia. And POS Malaysia also lack of supply chain and logistic network because of cost issues, which are pricey. When it comes to opportunity, POS Malaysia has a reputation for exceptional customer service and the strong brand awareness in the premium segment. When it comes to trade, commoditization of the product segment in the service sector are become more and more generic. And that's all about SWOT of POS Malaysia.
Okay, so moving on to the next part, which is the financial statement analysis. I will be talking about the profitability ratio trend analysis for 2 years, which is for year 2020 and year 2021. In this profitability ratio, we will cover about the gross profit margin, the operating profit margin, and also the net profit margin. Okay, so we will dive into the profitability ratios for POS Malaysia first. Here, gross profit margin tells us about the amount of money left after subtracting the cost of goods sold. Higher percentage of gross profit margin indicates that the company is more profitable. However, for POS Malaysia, we can see that the financial health is declining, as in 2020, the gross profit margin went from 12.04% to 7.44%. Next, we have the operating profit margin, which shows the company's ability to manage its indirect costs from its operation before subtracting the interest, charges, and taxes. The operating profit margin also decreases from 7.29% to 1.66% in 2021. This decline might be because of the increase of the operating costs that could not be overcome by setting a higher price or even attracting more customers. And lastly, we have the net profit margin. Net profit margin measures how much profit generated by a company as a percentage of revenue. Even though both the gross profit margin and the operating profit margin for Pos Malaysia decreases, the net profit margin for Pos Malaysia increases. In year 2020, the net profit margin recorded was 1.30%, while in 2021, it recorded 1.51%. As for GDEX's profitability ratios, all three of the gross profit margin, operating profit margin, and net profit margin shows an impressive increase from year 2020 to year 2021. The gross profit margin went from 25.08% in year 2020 to 25.27% in 2021. It shows that GDEX is making more profit in 2021 compared to 2020. GDEX is also properly managed given that the operating profit margin went up from 5.46% in 2020 to 8.11% in 2021. And lastly, the net profit margin also went up from 6.52% in 2020 to 9.13% in 2021. Next, we will go into the cross-sectional analysis, where we will compare the trend analysis for Pos Malaysia and GDEX. From 2020 to 2021, Pos Malaysia's gross profit margin can be seen decreasing from 12.04% to 7.44%. Meanwhile, GDEX is increasing from 25.08% to 25.27%. Here, it can be concluded that GDEX can make more reasonable profit on sales compared to Pos Malaysia. Once again, as compared to Pos Malaysia, GDEX has a better operating profit margin that shows they have a high quality of earnings. It can be seen here when Pos Malaysia operating profit margin in year 2020 is decreasing from 7.29% to 1.66%, while GDEX increasing from 5.46% to 8.11%. For the net profit margin, both Pos Malaysia and GDEX shows an increase from year 2020 to 2021. Pos Malaysia had a slight increase over the 2 years from 1.30% to 1.51%. As for GDEX, it had quite a wide gap of increment, which is 6.52% to 9.13%. If we compare the wide gap of the increment, GDEX is better and more efficient at converting their sales into actual profit compared to Pos Malaysia. Next,
I am Raden Siti Noisha and I will be presenting the trend analysis of 2 years of Pos Malaysia. Liquidity ratio measures the capability of a company to pay off its debt. Current ratio measures a company's ability to pay its current liabilities with its current asset. In 2021, Pos Malaysia's current ratio decreases to 0.87 times from 0.94 times in 2020. This shows that Pos Malaysia has a lower capability to pay its debt in 2021. Asset test ratio measures whether the current asset of a company can pay off its liabilities. Pos Malaysia's asset test ratio falls from 0.93 times in 2020 to 0.8 times in 2021. This is probably due to a decrease of Pos Malaysia's current assets in 2021. Inventory turnover ratio is the number of times a company to sell its stocks. In 2021, it will take Pos Malaysia 362.07 times more to replace its inventory than in 2020. Accounts receivables turnover ratio indicates how long it takes for a company to collect their debt from its customers. Post-Malaysia's accounts receivable turnover ratio had a decrease of 0.4 times in 2021 compared to 2020. This shows that Post-Malaysia has a slower debt collection in 2021. Accounts payables turnover ratio shows how long for a company to pay its creditors. Post-Malaysia's accounts payable turnover ratio increases in 2021 with 0.34 times than in 2020 with 0.31 times. This shows that Post-Malaysia is faster in paying its creditors in 2021. In 2021, GDEX's current ratio increases to 5 times from 4.74 times in 2020. This shows that GDEX has a higher capability to pay its debt in 2021. GDEX's acid test ratio rises from 4.72 times in 2020 to 4.98 times in 2021. This is probably due to a decrease of GDEX's current liabilities in 2021. In 2021, it will take GDEX 34.77 times more to replace its inventory than in 2020. GDEX's accounts receivables turnover ratio had an increase of 0.29 times in 2021 compared to 2020. This shows that GDEX has a higher debt collection in 2021. Meanwhile, GDEX's accounts payable turnover ratio increases in 2021 with 7.82 times than in 2020 with 3.68 times. This shows that GDEX is faster in paying its creditors in 2020. In 2021, Post-Malaysia's current ratio decreases to 0.87 times from 0.94 times in 2020. Meanwhile, GDEX's current ratio increases to 5 times in 2021 from 4.74 times in 2020. GDEX has a higher current ratio which is 5 times more than Post-Malaysia with 0.87 times. This shows that GDEX has a higher capability to pay its debt than Post-Malaysia. Post-Malaysia's acid test ratio falls from 0.93 times in 2020 to 0.87 times in 2021, while GDEX's acid test ratio rises from 4.72 times in 2020 to 4.98 times in 2021. GDEX has a higher acid test ratio than Post-Malaysia, and just like the current ratio, it shows that GDEX is more capable of settling off its debt than Post-Malaysia. In 2021, it takes Post-Malaysia 362.07 times more to replace its inventory than in 2020, and it takes GDEX 34.77 times more to replace its inventory in 2021 than in 2020. Overall, Post-Malaysia's inventory turnover rate is better than GDEX. Post-Malaysia's accounts receivable turnover ratio had a decrease of 0.14 times in 2021 compared to 2020. GDEX's accounts receivable turnover ratio had an increase of 0.29 times in 2021 compared to 2020. This shows that GDEX has a higher debt collection rate than Post-Malaysia, which translates to better in collecting debt. Post-Malaysia's accounts payables turnover ratio increases in 2021 with 0.34 times than in 2020 with 0.31 times. GDEX's accounts payables turnover ratio increases in 2021 with 7.82 times than in 2020 with 3.68 times. GDEX pays its creditors faster than Post-Malaysia.
Next is leverage ratio of both Post-Malaysia and GDEX for year 2020 and 2021. Debt ratio is the percentage of a company's assets that are financed by debt. So, Post Malaysia's debt ratio climbed from 63.9% to 69.8%. Meanwhile, GDEX shows a decrease of 2.1% in 2021. This is proven that Post Malaysia has a higher percentage of assets that are financed by debt than GDEX. The cover interest ratio is used to assess how easily a business can pay their interest on its existing debt. So in our analysis, Post Malaysia is performing better than GDEX in terms of making interest payments on its current debt, even though both of the companies shows an enhancement.
The efficiency ratios include earning per share (EPS), returns on capital employed (ROCE), return on assets (ROA), and returns on equity (ROE). In the trend analysis of Post Malaysia, based on the data, Post Malaysia has EPS of -39 cents in 2020 and -43 cents in 2021. This means that the ordinary shareholders of Post Malaysia faced loss in these 2 years. In 2021, Post Malaysia has a rate of -0.26%, which is much more lower than the ROCE ratios in 2020, which is -0.18%. This shows that in 2020 and 2021, the firm does not use its capital efficiently in generating profits. For the returns of assets, in 2020, Post Malaysia have the rates of 0.05%, while it only has 0.01% of ROA in 2021. This shows that the return after tax of Post Malaysia for every 1 ringgit Malaysia of its assets in 2020 is more than the return after tax in 2021. Post Malaysia have a ratios of 0.16% of ROE in 2020 and it has a ratio of 0.03 in 2021. This indicates that Post Malaysia did not use the capital invested by the shareholders efficiently in 2021 since the ROE turns lower. For GDEX, GDEX has a higher ratio of 0.75 cents of EPS in 2021 compared to 2020, which was 0.33 cents. The shareholders in GDEX may earn 0.75 cents for each share they owned in 2021, which is much more than 2020. For ROCE, GDEX ROCE in 2021 shown a higher rate of 0.12% compared to the ratio of 0.05% in 2020. Hence, GDEX has generated higher profits in 2021 using its capital. ROA ratios of GDEX for 2020 is 0.03%. The ratio increased in 2021 to 0.07%. This indicates that GDEX has made good use of its assets in 2021 since the profit increased. GDEX has a ROE rate of 0.05% in 2020 and a rate of 0.13% in 2021. The data showed the GDEX has better performance in 2021 since the ROE increased. For the EPS of Post Malaysia and GDEX, in 2020, Post Malaysia earnings per share is -39 cents, while GDEX has EPS of 0.33 cents. In 2021, the EPS of Post Malaysia decreased to -43 cents, while the EPS of GDEX increased to 0.75 cents. So overall, GDEX has better performance than Post Malaysia either in 2020 or 2021. The ROCE of Post Malaysia in 2020 is -0.18%. However, it dropped to -0.26% in 2021. For Post Malaysia, it faced more losses in 2021. On the contrary, GDEX has an increase of ROCE from 0.05% to 0.12% in 2021. So GDEX have better performance in both years compared to post-Malaysia. So for return of assets ROA, in 2021, the return of assets of post-Malaysia decreased from 0.05 to 0.01%, while the ROA ratios for GDEX has increased from 0.03% to 0.07%. This indicates that GDEX has better management on its assets to make profits in 2021. In year 2020, Post-Malaysia has higher ROE compared to GDEX. However, GDEX has higher ROE in 2021. The investors of GDEX will earn more in 2021. GDEX has improved its performance and it surpassed Post-Malaysia's in 2021.
Now I will explain the strength analysis and cross-sectional analysis of market ratio. First, I will explain market ratio of Post-Malaysia. Post-Malaysia shows a negative price-earning ratio of negative 3.51 times in 2020 and rose to negative 3.919 times in 2021. It means that Post-Malaysia will lose less money in 2021. And Post-Malaysia indicate an undervalued stock price as 0.94, indicating that the company market value is now trading below its book value per share in 2020. Its market to book ratio increased to 1.32 in 2021, indicating that the company's stock price is excessively high and that its market value is higher than its book value per share. And now I will explain the market ratio of GDEX. GDEX positive price earning ratio for 2020 is 72 times, which indicates that the company is selling its share for 72 times its earnings. Its price earning ratio fell to 46.63 times in 2021, meaning GDEX saw its share only 46.63 times its earnings. In 2020 and 2021, the market to book ratio of GDEX are 2.45 and 3.92 respectively. It means that the value of GDEX is overvalued for both 2012, 20 and 2021 when the market value of the company is more than the book value of the company. And now I will explain the cross-sectional analysis among the Post-Malaysia and the GDEX. The price earning ratio of GDEX is better than Post-Malaysia. Post-Malaysia showed negative price earning ratio for both 2020 and 2021, which means that Post-Malaysia made no earnings for both years. Therefore, it is a good idea to invest in GDEX, where GDEX share currently sell for 72 times its earning in 2020 and 46.63 times in 2021. And now I will explain the market ratio, which is the market to book ratio for GDEX and Post-Malaysia. Market to book ratio of GDEX is higher than Post-Malaysia for both 2020 and 2021. In 2020, GDEX requires 2.45 ringgit Malaysia for each share, but only for 0.94 ringgit Malaysia for Post-Malaysia. In 2021, GDEX requires RM 3.92 for each share, but Post-Malaysia requires RM 1.32 per share. So in conclusion, there is a huge amount of funds needed if chosen to invest in GDEX compared to making an investment in Post-Malaysia.
The corporate issues and recent news for Post Malaysia is it reported a net loss of 33.63 million for the third quarter of the year 2022. And because of this, Post Malaysia intends to lessen the effect of declining parcel quantities by cutting transportation costs. This loss is also due to Post Malaysia's competitors actively reducing prices to increase their market shares. Post Malaysia also released the first non-fungible token, also known as NFT, stamps in Malaysia. And this initiative would increase productivity and better interaction with customers. Post Malaysia aims to deliver shipments the following days for 92% or more of shipments. And also, based on Charles Brewer, the CEO of Post Malaysia, states that the company handles 400,000 of shipments per day, 2 times its average load. Post Malaysia's share price has decreased by about 40% from its peak of 120 cents in December 2020. Post Malaysia's revenue increased by 13.3% to 623 million in the third quarter of 2020. This is because of the implementation of MCO in October that leads to a rise in online purchasing. For GDEX, it reported a net loss of 6.57 million for the third quarter ending 30 September 2022. The company attributed the drop in losses to intense competition, weak economy, and the rise of labor cost. GDEX has a diverse approach to accomplishing the objectives of GDEX 2.0 by investing in new businesses, forming alliance with businesses, and investing in firms like NetCo. GDEX disclosed a 41% increase in net profit to 26.09 million, with a growth in revenue to 430.51 million, and the reason for this is cost savings. GDEX reported a rise in revenue of 15.7% to 363 million in the financial year ending 30 June 2020. The company credited the rise in sales for delivery services and increased profit following the MCO implementation. That is all for me. Thank you.
Next, we will talk about the stock performance for both companies, which are Post Malaysia and GDEX. First, we will go into the Post Malaysia stock performance for year 2020. The highest stock performance recorded for Post Malaysia in 2020 was on the 2nd of January 2020 with 10.1 million stocks sold at price RM1.50. This is because Post Malaysia is one of the top non-courier services in Malaysia alongside with some other courier services, hence making the number of stocks sold quite high. With this being said, investors tend to invest in big companies such as Post Malaysia to ensure more return for themselves. The lowest stock price was on March 15, 2022, where it recorded 625,000 stocks sold at price 77 cents. This is because of the COVID-19 pandemic outbreak globally. Starting from that point, the stock's price is never as high as the price sold before the pandemic. It is understandable that the stock's condition is unstable in 2020 because of the uncertainty of the investors to invest when the whole world was undergoing a big change so suddenly. Even Post Malaysia is affected by this pandemic outbreak, hence they had to restrict their operating hours to comply with the Movement Control Order MCO established by the Malaysian government. However, throughout the next quarter of year 2020, the stock performance can be seen recovering as Post Malaysia had made advances such as partnering with Shopee and online shopping campaign under the name Stay Home Essential. Next, for year 2021, the highest stock price for Post Malaysia in 2021 was RM1.22 on the 4th of January with 2.5 million stocks sold, while the lowest price was 59 cents with 3.1 million stocks sold on December 12. Compared to 2020, Post-Malaysia suffered from a revenue decline from 2.33 billion to 2.19 billion in 2021. It is said that the reason for the decrease is because of the drop in postal services, also followed by the decrease in mail and parcel volume handled mostly from the contract customers. Additionally, the higher loss registered for the postal segment was granted by a mutual separation scheme of 75.1 million in comparison to 41.6 million recorded in FY 2020. As a result, Post Malaysia had to deal with a net loss of 335.73 million for FY 2021. In 2020, GDEX stock performance reached its peak on the 15th of November 2020 at price 45 cents with 252.2 million stocks sold. As mentioned before, almost all companies experienced a downfall with the appearance of coronavirus disease, and GDEX is not an exception. However, they were quick to get back on their feet as they get used to the new norms. They took advantage of the fact that the customers cannot leave their homes freely anymore and took action from the increasing number of online purchases made by consumers. It can also be seen from the profitability ratios for GDEX, where an excellent position of the gross profit margin is at 25.08% and the net profit margin is at 6.25% in 2020, which strengthens the claim that GDEX 2020 revenue is increasing. While the lowest stock price for year 2020 was 16 cents with 17.3 million stocks sold. As for year 2021, the peak performance was on the 13th of January with 13.9 million stocks sold at price 41 cents. According to GDEX's financial statement, it is undeniable that GDEX showed a better performance in 2021 compared with 2020. GDEX is set to focus on generating a positive cash flow despite the fierce competition in the industry, which has resulted in a higher cash position on their side. On the 21st of December, GDEX noted its lowest stock performance at 213,900 stocks sold at price 28 cents. The excellent result from the previous year might have encouraged the investors to keep on investing in GDEX. We can see from the profitability ratio of GDEX, such as the gross profit margin and the net profit margin, are showing a positive change from the previous year, which was year 2020. Also, one of the contributing factors is due to the better cost control in the express delivery segment, which was more than enough to offset the 4% decline in the quarter-on-quarter revenue decline. To simply conclude both stock performance, GDEX has better stock performance compared to Post Malaysia in both year 2020 and 2021.
So, when it comes to the conclusion, the GDEX total financial analysis for both 2020 and 2021 is better than Post Malaysia. GDEX performs better in terms of profitability, liquidity, leverage, efficiency, and market ratio in 2020 and 2021. Therefore, the investor should put their money in GDEX both in the long term and short term, if compared to Post Malaysia. For the long term, the investor can base their decision for long-term investment on the leverage ratio. The ratio's outcomes reveals the proportion of a company's asset that will need to be liquidated in order to pay down its long-term debt. GDEX might have less debt in 2021, as seen by a debt ratio that dropped from 24.3% in 2020 to 22.2% in 2021. A debt-to-income ratio of 20% or less is regarded as less dangerous and easier to borrow money if necessary. A rising interest ratio from 2.92 times in 2020 to 76.25 times in 2021 demonstrate how much better GDEX perform when it comes to paying interest on current loan. For the short term, the investor can base their decision for short-term investment on the liquidity ratio. A company's ability to pay its short-term obligation is measured by its liquidity ratios, which are essential signs of its financial health. A rising current ratio from 4.74 times in 2020 to 5 times in 2021 demonstrate GDEX's strong ability to pay back its debts. The asset test ratio has increased from 4.72 to 4.98 in 2021, indicating that GDEX has improved its ability to pay its existing creditors. GDEX was able to quickly collect its debt from its customer as seen by an increase in the account receivables turnover ratio, which went from 0.19 times in 2021 to 0.48 times in 2021. Account payable turnover ratio increased from 3.68 times in 2020 to 7.82 times in 2021, indicating that GDEX was paying its debtors more quickly than in the previous years. So that's all from our group. Thank you for your attention.